Hello, this is Simon from Strategize Financial Modelling. Today I'm going to discuss the importance of fully modelling a service-based contract using best practice financial modelling standards. As per my article, it's not just simply a matter of undertaking a back-of-the-envelope calculation to model or price a service contract. It's also important to account for the myriad of operating expenses, capital expenditure and labour costs that need to be fully costed to ensure a profitable price is tendered for during contract negotiations. As you can see, my table of contents is a lot more detailed than a conventional financial model, particularly in the assumptions area, and I'll show you why now. Time series assumptions fairly self-explanatory. Obviously, we're assuming our contract is going to start on the 1st of January 2012. However, it's the other detail it's a lot more micro than a conventional financial model. For example, a strategic plan where you're undertaking a more macro perspective of a company's financial statements. This is a lot more detailed, and as you can see, it's important to fully account for and document all labour, all startup costs, and as I'll show you further, capital expenditure. So as we can see here, it's also vital to account for not just inflation but also cash flow factors. So we're going to assume a uniform 40 days for debtors and creditors, and also the amount of work that will take to service the contract in terms of your overhead labour, and also accounting for the additional labour costs that are dependent on a jurisdiction, industrial law. So here are our revenue assumptions. This is fairly high level, this contract. We're assuming $2,500 per cargo activity, $500 per freight forwarding. Cargo cost of labour, as I said, this is where the detail comes into play in terms of the level of cost that we've got to account for, which is often underestimated by companies in servicing a contract. It's not just the actual direct labour that you've got to realise is going to service that contract. It's also executives who their time has to be fully accounted for under the auspices of activity-based costing. Similar here for our freight forwarding, we have to fully account for all our employee or executives' time in servicing that contract. Similarly with capital expenditure, we often misstate the importance of utilising existing capital expenditure, which is shown here. We're accounting for documenting all our existing capex, and then we're using this arbitrary 4.1%, which is quintessential activity-based costing, whereby we're assuming that this 156.4, I know that's arbitrary, it's the amount of activity to service this contract, how that will be allocated to the existing capex. And don't forget, we may also need to undertake new capital expenditure. Also, operating expenses or leasing expenses. Now, this sort of detail, I know it's very tedious to undertake, but once it's set up, it can be utilised in future service-based contracts. And as always, under best practice financial modelling, it's important to maintain plenty of space. So we'll now move to the outputs. And as I discussed, the revenue, once again, if needs be, we have plenty of room to flex this model to account for additional activities to service the contract. The cost of labour, as I discussed, is obviously going to be a lot higher. Now, we've accounted for our forecasted overhead, and now we can obviously forecast out our cost of labour throughout the whole life cycle of the project, which is often overlooked by companies. They often just use historical costing in a contract, which will obviously greatly overstate the profit margins that they'll end up achieving over that life cycle of that contract. Similarly here with the freight forwarding, it's important to fully account and forecast all your labour costs, and also obviously account for other indirect costs such as overtime and other statutory labour requirements. Similarly with CapEx expenditure, also we're going to take a contingency on our existing CapEx. We also obviously that'll filter through into depreciation. Also with our operating expenditure, which obviously just comes off our assumptions worksheet, we want to make sure that we're fully accounting in terms of future value, the cost of these expenses. So we can now present all these costs and obviously revenue figures in our income statement. And obviously, as per best practice financial modelling, there's obviously the respective error checks, just reconciling these numbers back to their source worksheets, such as our cost of labour. Now, often a cash flow statement, well, not just a cash flow analysis, but also a cash flow forecast is overlooked when modelling a contract. And obviously, in terms of intrinsic added value to a company, it is imperative that this contract is actually going to deliver added value. And as we can see here, we do the cash flow statement under the 3 direct, indirect, and also capital providers to ensure that our numbers are all reconciling. Now, the high-level executive summary, obviously, we want to present everything on an annual basis, and as we can see here, our costs, whilst our revenue is going up, obviously our costs are going up too, and that's obviously important. As I discussed, with modelling a contract, it's not just obviously accounting for the indirect costs, it's also accounting for costs that are going to arise with inflation, and that's what this model is doing here. And obviously similarly for the cash flow statement, the importance of fully accounting for the cash flow impact on your company. One of the other important aspects that's often overlooked is the important metrics such as payback period. As we can see here, this is fine. We're getting a payback period of essentially in about just over a month, and also we're delivering added value to the company from servicing this contract, which is obviously important. So there we have it. That's the high-level detail that obviously executive management want to see to understand what this contract is, how it's impacting on the company's bottom line. And as per best practice financial modelling, we also obviously have appendices for lookup tables and obviously our error checks. So there we go. The way to accurately and appropriately costing a service-based contract to ensure that your company will be able to better price contracts based on budget and forecast expenses in order to deliver appropriate forecasted return on sales, profit margin and cash flows. Thank you.